It is a difficult process when you're in those large firms where you can get into really big trouble for what they call selling away, just selling outside of the investments that have been approved. So advisement has been, the way that we structured my business from the beginning and how we structure it today. What I do is I'm putting them and their best interest before my own, and then it benefits me over time because the relationship stays there for much longer.
A lot of financial advisors and wealth managers care more about forcing their clients into a box to protect their AUM fees than they actually care about looking for innovative alternative approaches that truly expedite the wealth building or wealth preservation journey. But not Richard McWhorter. His edgy, creative, and innovative approach has earned him the privilege of being a private wealth advisor to ultra high net worth clients spanning the sports, the entertainment, and the music industry. He's been recognized by elite publications like Forbes and Barron's and the Financial Times. And this Beverly Hills-based wealth wizard is joining us today on On the Exit to unlock the money secrets of the ultra wealthy. So Richard, welcome to On the Exit.
Thank you guys for having me, and thanks for the wonderful introduction.
Come on. That's awesome. So Richard, tell us a little bit about your background. How'd you get started in this world of, creative, edgy, innovative wealth management?
So I started when I was 17 years of age. I was just out of high school, got an internship at a company back then by the name of Deanwood Reynolds, and started learning the business and started off as an intern, then became a receptionist, and I was a sales assistant, and then became a financial advisor in 1992. So it's 32 years ago now.
Wow. So is that always what you kind of wanted to do, or did you fall into it at 17?
Fell into it. Just luck of the draw, got an internship, and just fell in love with the business over time.
Wow. I know that talking to various financial advisors, I've heard it can be a very tough business initially to kind of break into when you're first starting, trying to build those networks that gain that trust. How was your experience early on? Was it tough?
Yeah, it's a really difficult business to build a practice. It took me about 10 years, 12 years to really start to build a base. And then during that period of time, I talked about getting out of the business for a while and going into management within a firm. And I talked about a lot of different things because it's a lot of hours. And, we were working 14, 15, 16-hour days. And back then it was the first one in the office and the last one to leave. And that's how you worked. And you were up against other people that were back then we had what they call a bullpen. And in that bullpen, you had all the rookies that were trying to just build a base. So.
Right.
Wow. So there's a lot of people that probably dropped out. I would imagine over each year, there was probably a purging, right?
Yeah, I had 53 in my training class, and I think there's 3 of us left.
Wow. Yeah. So a lot of churn, kind of similar to, like the sales industry in general, right? A lot of turnover, a lot of churn. So what are some of the overlaps? I mean, obviously there's a big part of what you do is sales, right? I mean, you're selling clients on your ability to manage their finances, and then you're selling financial products to them and things like that. So, tell us a little bit about, what's some of the overlap there?
So, when you put it into perspective, are you advising or are you selling? And those could be completely different beings. As far as selling, if you had to do certain things that, quotas, and back in the day there was quotas and there was those types of things, and you always had a choice whether to do those things or not. I've always had a really hard time with that idea. So advisement has been the way that we structured, or that I structured my business from the beginning, and how we structure it today. And it's, if you're always putting what's best to the client before your own, the fiduciary rule, then theoretically, you're just going to continue to advise in whatever that is. And the types of clients that we deal with are dealing in such a diverse range of investments and businesses, and we've done sports teams and music catalogs, and primarily in basketball, we've dealt, with contracts there. you get into a whole wide array of things that are outside of the scope of what we do on a daily basis, but they still want someone that they trust, someone that's going to give them unbiased opinions, whether good or bad. And so that's really how we've structured our business.
Wow, yeah, that's cool. I'm just thinking of like a lot of different financial advisors or platforms they're on, or their company that they're with could limit the options, right? So is that something that you came up against, where you found like, hey, I can only offer you a very narrow kind of suite of the traditional products, right? But then for these ultra high net worth folks, they want access to things beyond that, right? So how did you kind of move toward the more creative approach and things like that?
It's very difficult at large firms, and I was at two of them, to advise outside of the scope of what they've approved and what they allow you to sell.
Yeah.
For example, if you asked me when I was at one of the firms for a mortgage, I would have to show you a mortgage of that particular firm that was offered by that firm. If you wanted to advise, I would go out and get 6 or 7 different quotes from different banks and work with, whatever bank's giving me the best deal at that time.
Yeah.
So you had to decide if you were going to advise or you're going to sell. And that difference was a decision that we all make. Now that I've gone independent, I don't have those inherent conflicts of interest any longer.
Yeah.
And so therefore, but we've always had to work on how we're going to show our clients what's best for them. Sometimes it's what the firm has to offer, but primarily it's not. And you have to be out there explaining that to clients that they need to be getting other quotes from other firms or other banks. But it's like that across the board with investments in general. There's certain investments that are approved and not approved, and some of them might be outside. Private equity is a big one. Private credit's another one, and they have relationships with these guys. And so you have to kind of stay within that realm. I would say that there's a lot of great companies out there that were not approved on a lot of these platforms, or so you have to. It is a difficult process when you're in those large firms, where, because you can get into really big trouble for what they call selling away, which is selling outside of the investments that have been approved.
Yeah, even if it's in the client's best interest.
Even if it's in the client's best interest.
Yeah, and that's. We're in our primary business in the kind of alternative investment space. And so we recognize, the opportunity there. We also recognize and understand the risk there. And so, but what we've run into a lot is, clients of ours that have financial advisors that are kind of stuck in that sort of platform box that are, not really looking out for the client's best interest, but are, we've always understood it as kind of protecting their fee, because when it comes down to it, if we're able to figure out a way that they still get paid, they don't have a problem with it. Like that's happened a couple of times. We actually had an NFL player that invested with us through his financial advisor, and he was like, once the financial advisor was able to figure out how they were going to get paid, they had no problem with him investing in the deal,
Right. No, it's a valid point. I think it happens more times than not, for sure.
And one of the challenges, I want to get your take on this, as I've talked to a lot of folks, one of the challenges is, I've got a client that did a quick Google search on the average net worth and income of a financial advisor, and it was like $117,000 a year.
Okay.
And so his thing to me was like, why am I even listening to this guy who has like a tenth of the income that, you know what I mean? Like,
100%.
So tell us, you've been able to set yourself apart, man. I mean, you've been able to give us some of the, I want to dive into the meat, you know what I mean? Like what are the things that your kind of ultra high net worth clients, what are the types of things that they're looking at that you're advising them on? What does a Richard McWhorter kind of edgy, innovative approach look like? What is that?
No, a lot of it is coming from the clients, right? A lot of the clients have built wealth outside of Maine. And, I had a client, 28 years ago now or whatever. And he said, I was 24 at the time. And he said to me, he goes, don't come in and tell me you're going to make me rich. I am rich. Just don't mess it up. He didn't quite use those words. I'll keep it rated G. So, but my point is that, a lot of these guys that come in that have built real estate businesses, primarily private businesses, and they've built these things up, and that's where their real wealth comes from. A lot of what I do is attain that wealth, get a rate of return, let them live the lifestyle that they want to live, whatever that is. So, a lot of that it comes from the client, and it comes from the types of things that they're interested in. And from my perspective, or what I do, is that I just want to understand the ramifications of whatever they decide to do. How does that impact them? And as you have these relationships with these clients, a lot of that has to do with, how do I know them, I know their behavior, I know who they are, I know what they've said to me before. And then as you understand the ramifications, both, and critically think through, what the positives and the negatives of whatever they're deciding to do or wanting to do, and then explaining it to them. And I've had clients where they've come to me and said, I've got an attorney that's setting up all these charitable trusts, and I know the client, and they're not charitable in any way. And so why are we doing charitable trusts for someone that's not? And they spend thousands and thousands of dollars on these trusts. And from my perspective, I sat them down and I said, okay, so do you know what this means, right? When you put money into these trusts, it's irrevocable. And when you do this stuff, and he's like, no, that wasn't explained. And so it's my job to come in there and explain, here's the positives, here's the negatives, right? And I do that across the board. So not only investments, what's going on in the economy every year, and the one thing that I know is I don't know. That's what I can tell you, right? And so I come up and I look at the positives and the negatives and the possibilities and try and understand that to the best of my ability. The reality is I'll never truly figure it out. And so, but if I can explain that to the client, here's the possibilities or the possibilities that I can see, that's how I go about my business. And if they're going to do stuff outside of me, going back to their point prior, they're going to do stuff outside of me, and that's okay, right? If I'm scared of them losing, if I manage $50 million for somebody and these guys are, going to take $1 million or $2 million or whatever that number is, the reality is that it's still $48 million, and I want to maintain that relationship more than anything else.
Right.
And so by doing what I do is I'm putting them and their best interest before my own, and then it benefits me over time because the relationship stays there for much longer.
Yeah. No, that's absolutely, I think it's a fantastic approach, and it's refreshing it's a refreshing perspective. Because I've had too many bad experiences with financial advisors, and so it's refreshing to hear hey, this is how I do it. And if one of my clients comes and says this is something I want to do, I'm not going to tell them not to, and I'm not going to tell them to do it. I'm going to tell this is what the benefits of that decision would be. This is what I think the potential downsides of that decision would be. What do you want to do?
That's exactly right. And the critical thinking through that stuff is most important. Yeah, as you guys know, when you hear people and what they do and how they do things or what they think is going to happen and all this stuff. Yeah. My response is always maybe. Maybe that's going to work. Maybe that's the way it's going to play itself out. But then what? Maybe not. Right. And so, this want for certainty on anything that we do, and the want for, someone like myself to basically come back and go, this is the way it's going to be. That's the most arrogant thing I think I can possibly do.
Right.
So for me, it's here's what it is. And ultimately it sells itself, right? I got a pretty big toolbox of stuff. The question is, what in that toolbox am I going to use for each one of these clients individually?
That sounds a lot of fun, like with the strategy side of it, because, with the traditional approach is well, no, you're just going to fit into this box and there is no strategy. Everyone just does the same thing, right? But I can see how these folks, they're not for that. They want a tailored plan.
Listen, the average client that we deal with is in that 25 to 50 million. We've got a couple clients that are worth $7-8 billion now. And, we manage $2 billion of that. Right, just under $2 billion. Yeah. So my thesis is that, when I'm looking at the types of people that we're dealing with, these guys have all been hyper successful. And so, I used to question quite a bit, why are these guys that are hyper successful coming to get my opinion, right? And there is that vulnerability in saying that, right? But the reality is that because they trust my opinion, they trusted I was going to tell them what I felt was best for them. And that takes time to build up over, years and years. But you're talking about guys that have made $1 billion, $5 billion, $7 billion that are looking for me. To your point earlier, the average financial advisor has $113,000. Makes $113,000 or $117,000 bucks. So what the hell are they coming to me when they've made $1 billion, right? But it is that opinion, right? They somehow start to want to at least hear my voice. Now there could be 15 other voices that they listen to, and then they're going to make up their own minds. But we've kind of put ourselves in that game, to be called on when necessary. So.
Yeah, I'd love to. I know you have authority and expertise in obviously, the financial wealth advisory aspect of things, but also overall kind of economic realities and economic trends. I mean, that's obviously a tremendously important thing when you're advising clients and giving them upside and downside risk scenarios and all that kind of stuff. So I love just asking this general question. What's your current outtake in general of the overall economy?
Don't know yet. Don't know yet. And a lot of that has to do with there's so many changes happening so quickly, right? And so to understand, like I get hit on all the time in regards to the tariffs, right? Let's just use that one. Yeah. But the tariffs haven't even started yet, right? We still have inventories we're running off. We still have a bunch of other things that are happening. Tariffs haven't really even kicked in. We're starting to see some of that now, but it's been postponed to August 1st again, I believe. Yeah. So when you're looking at what tariffs are going to do, are companies going to eat that in the profits? Are they going to pass that on to the consumer? Are the countries going to eat it? Right? All those types of things. We don't know what that means yet. So as much as I would love to tell you this, we're going to see inflation and therefore interest rates are going to go higher, I don't know because we haven't seen it yet. We track it every week, and my staff we've all chosen 25 different products, and we track it every single week, and we chart it out, and seen a couple changes here and there, but really nothing significant. So my point to everybody is just wait. We got to wait a second here, right? I don't even know which way interest rates are going to go, right? And I spend a lot of time on interest rates. It's about 74% of my business because of the types of clients that we deal with. But my point is that, listen, I know that the administration wants us to drop interest rates. The last time we dropped interest rates, actually the 2 to 30 year bonds all went up in yield. So the question is that what we want? Well, there's a debate to raise interest rates. But will that actually bring down longer term interest rates? So it's looking at all of those scenarios and understanding, when we lower interest rates, are interest rates going to go higher or lower on everything from 2 to 30 years out? Are tariffs going to hit and we're going to start to see inflation coming about? So to answer your question directly in a long-winded way is that it's too early to know. Yeah, in my opinion.
Yeah, and speaking of, the interest rates, it's like we know, the Fed itself is a reactionary institution. They're not trying to forecast and look at what could potentially happen, and everybody else is that's what they're thinking. What could potentially happen? Well, the Fed's not going to do it until whatever happens actually happens. They react, right? They don't proact. So would you agree with this? I mean, I kind of track some of a lot of the betting sites and things like that in terms of probabilities because of a lot of honestly, what I've seen is the accuracy of those sites in terms of being able to at least somewhat predict what interest rates are going to do in the future, a lot more accurate historically than trying to read the Fed signals, right?
Yeah. For sure. And listen, the thing that we have to understand about all this stuff, right? Even if you look at the probabilities of accurateness in the betting sites, I play poker. Yeah. When I go into a hand and I look at a hand, this just happened the other day, I have a 90% chance of winning this hand. But that also means I have a 1 in 10 chance of losing this hand. And we have to understand that I have to understand when I go bet that hand that there's the potential of losing that hand 10% of the time.
Yeah.
So when we're looking at any of these probabilities, I think a lot of people were taken aback by the idea that when the Fed dropped interest rates in September of last year, that when interest rates went down by 50 basis points, half of 1%, the 10-year went up as much as it did during that period of time. So the question is that, even though the Fed is reactionary and the market is trying to get in front of that, they're not always right? I mean, otherwise the 10-year wouldn't have gone up by so much because the Fed signals these interest rate cuts, right? And so we start to hear about it, and we start to, I think it was like a 90% chance or 95% chance they were going to cut in September. Everyone thought that interest rates were going to come down.
Yeah.
And then all of a sudden the bond market responded the opposite way. So therefore the market, who was trying to be proactive in dropping interest rates prior to the cut, actually bet wrong, and it went the other way.
Yeah.
I would imagine if you asked 10 people, 9 of the 10 people would have said that interest rates will go down when the Fed cuts interest rates.
Yeah. And they didn't. Yeah.
And they didn't.
Absolutely.
So
what do you think caused that?
I think, when they dropped it by that much, by 50 basis points, I think the market all of a sudden started thinking that when you drop interest rate, it promotes growth theoretically. And then if you you drop short-term interest rates, it will open up lending, and then the inflation or the growth of the economy will start to expand at a quicker pace than what the Fed wants it to do.
Yeah.
And so, right now, if we cut interest rates, are the tariffs, because the tariffs haven't even hit, like we mentioned earlier. If we drop interest rates and the tariffs start to create inflation, we can always respond to that. But to your point is that they're reactive. So how long into it do we start to hit?
Yeah.
Right? And the tariffs, the inflation starts to be in this economy. Because, one thing that I keep hearing is that the tariffs are going to be a one-time event.
Yeah.
And I disagree with that 1,000%. And the reason I disagree is not necessarily that it's not a one-time event. It is a one-time event. But then you have compounding of inflation on top of that.
Right.
Right. So if you go back to 2022, I believe, is when we hit 9.1% on the inflation rate in June or July of that year. It's the 9.1 for that month over month, right? On an annualized yield.
Yeah.
I'm sorry, an annualized inflation rate. But what happens is that 9%, now you add on 2% or 3% the next month, and then it starts to compound. And so something that was $1 goes to $1.09, then goes to $1.10, then goes to $1.11, and it continues to compound on top. Mm-hmm. So unless you start to see deflation after the tariffs hit, it's not a one-time event or stagnation, right?
Right.
And you have a compound on top of that tariff.
And that's a lot of why I think what was even Jerome Powell said, that it was transitory, but not because it is that there is the reality of existing kind of nagging inflation that even if it's 3%, well, it's 3% of a much higher basis, if you want to say it in that way, right? Because of that compounding effect. Is that what I'm kind of hearing you say?
Yeah, 100%. And I think it's this, we have to understand that if we have these increases in inflation at any high level, 5%, 10%, 15%, it becomes the new norm, and then we just compound on top of that number. When you actually break down inflation, for example, 35% of inflation is one number, or approximately 35%. It's owner equivalent rent. It's what we can theoretically, right? So what happens with that number is that's a third of the number. We look at food and energy. All food, all energy is around 21% of the number.
Yeah.
Right? One number is 34%. So when you put these things into perspective and you break it down onto you can get this information. Consumer Price Index comes out every month, and it shows you the weightings of everything. In that number, you can see what's being effectual on inflation. But owner equivalent rent has been stubbornly high as home prices have gone up as well as interest rates have gone up. So it's more expensive. And by the way, it makes a lot of sense. That's our biggest purchase by far.
Yeah.
Right? Our basic expense.
Right. And obviously that's one that's not likely to correct or deflate. I mean, in the sense of you bring interest rates down to curb it, well, that just creates more buyers in the market because the debt's cheaper. Most people buy and they think monthly payment more than they think purchase price, right? If you can buy a $600,000 house for the same payment a year from now as you could buy a $400,000 house today, or, with your average consumer, then you're going to do that. Like you're going to get the bigger house, and then that drives prices up, right?
Good. I mean, unless we have some type of correction like we did back in 2008, and, we have a real decline in the markets across the board. By the way, I'm not calling for that in any way, but what I'm saying is that you would need to have a massive correction in the prices of properties at the same time interest rates are coming down to make that all more affordable. Because if you have interest rates that come down and you can afford more of a home and you spend more on a home, is that a wash, or is interest rates coming down faster than home prices are rising, and then that could be offsetting a little bit.
Yeah, absolutely.
So what are some of your thoughts around, in light of inflation, has that changed some of like how you advise, for clients, what types of assets they're going into, public markets, alternatives, hard assets, does that change at all in this, I guess, environment with a lot of inflation?
Sure. Yeah, right now, with money market rates around 4.20, whatever they're at the moment, it takes a little bit more for me to come out of those things and put it into the investments. A lot of people want to play the Magnificent Seven stocks, and I have zero interest at this point, just because multiples are so much higher than earnings growth. And if we start to look at earnings expectations for the next few years and you slap average multiples on these things, it's not even, from my perspective, it's highly overvalued. But there's always these opportunities, right? There's always various opportunities in the market, and you're looking for those various opportunities, whatever that may be, right? If you want to take AI back, by the way, I'm not going to talk about anything specific, but if you want to take AI back to the structure of AI, or artificial intelligence, what do we need underlying, Meta and all this other stuff? But maybe it's natural gas, energy. Maybe it's oil, maybe it's coal, maybe it's an alternative energy. Right. So if you see, Amazon and a lot of these companies are buying or investing in nuclear plants and things like that. And they know that we're going to have an issue at some point with not enough electricity to be able to do this. But what runs an electrical plant, right? Primarily coal and oil. Yeah. So you need these underlying, and I'm more interested in that underlying because really no one's focused on that. They're focused on what company. Listen, it's very similar to, and I'm not saying we're going to have a 2000, but it's very similar to the conversations that I had in 1998 and 1999 where valuations didn't matter, and then all of a sudden they did. Yeah. And so I want to own the stuff that people are really not interested in, and I want to own the stuff that's naturally there. Yeah. So, that's my personal opinion.
It's so interesting that you said that. We literally recorded an episode. I don't know if that episode's come out yet, but on this exact topic of, we are currently investing in a kind of diversified oil and gas fund. And the whole kind of principle behind that episode was, a lot of the reason behind that is understanding, like, by 2030, AI data centers alone, like the AI energy consumption for data centers alone, is somewhere in the ballpark of 945 terawatts, which is enough to power the entire country of Japan on an annual basis. Like, where are we going to get that energy?
Don't know.
And private equity investment in oil and gas exploration has went down 54% since 2014. So it's going to be high demand and continued constrained supply. And nuclear is a good option, I think, but there's also restrictions because it's a global problem, right? We just destroyed Iran's nuclear facility. We're not going to let them build you know what I'm saying? Like there's only a handful of countries in the world that are going to actually be able to get your, refined raw material, refined nuclear material to be able to even have nuclear energy production, right? And so that's a lot of the thing that I don't think people understand. It's running to the thing that powers the sexy thing rather than running to the sexy thing, right? Like, what's the undergirding infrastructure required for the shiny new object to soar?
That's exactly right. I mean, listen, I had this debate. I play a lot of golf, and I was playing golf with this guy, and he was telling me about all the stocks that he's invested in, of course, because That's what happens. And so he's telling me about all these AI stocks, and I'm telling him how I do things and what I'm looking at with all that stuff. And, it's just so boring relatively, right? I mean, I get a 4% dividend. It's got a correlation of this. And you go through this whole thing, and then you talk about utilities. But we focused on, he wanted to focus on electric cars, because here in California, it's a wild debate between those that believe in electric cars and those don't. So anyway, long story is that I have an electric car. For no other reason, I just didn't want to keep paying the gas. So what's funny about that is that we'll go through this concept of how green and all this kind of stuff. And my point to everybody has been, am I truly green? Or am I increasing the amount of electricity that's necessary, which is run by coal and oil primarily? And so therefore, am I actually reducing the amount of oil that's necessary? Or am I increasing the amount of oil necessary by charging all this stuff at my house? Yeah. So when you go through, and once again, when you critically think through these things versus just having a distinct opinion, right? And you really look at the backgrounds of things, it's so clarifying. And I always tell people, I'm just a data guy. So it's a non-emotional response. The data is the data, period. And it just tells me one way or another. I don't need to really have a hypothesis or think that I'm right or wrong. It's going to tell me what that is and what the probability of correctness is, by the way.
Yeah, it's the are you familiar with Thomas Sowell?
Sure.
Yeah. He talks about, you've got on one side the idealism of the vision of the anointed, of like, this is what it feels like it should be doing. And so that is what is reality. And then you've got empirical data,
right,
that just simply says, this is what the actual reality is. Right. And we've actually had this conversation often, Aaron and I drive a Tesla, mostly because it's a cool car. My kids call it the spaceship car. They like it. I like it. It's fun. And I don't have to go to the gas station anymore, right? Like, that's cool too. But it's made of probably 90% plastic, which is a petroleum byproduct, right? And so we're not and it, the raw materials in the rare earth minerals, right? In the cobalt and the zinc and the lithium and all that kind of stuff in the battery took tons of diesel fuel to mine that out of the earth, and, all of the different things. And so it's like, I like the environment. I like, clean water and clean air and all the stuff, right? Like, I'm not trying to, but at the end of the day, we have to, I'm just echoing and agreeing with you. We have to think from a realistic data. What's the actual real situation that's going on versus what makes me feel idealistically better than the other thing,
100%. But listen, I think that there's so much information that's so easily available today. Now, the problem with a lot of that is the accuracy of it all, right? Yeah. There's a lot of misinformation out there. There's a lot of talk. There's a lot of stuff on social media that people listen to. But when you get down to the source of the information, when you get down to, for example, right now I'm reading the Big Beautiful Bill. By the way, it's 800 pages, so it's going to take me a bit. But my point is that when you read it, I can get a summary off of television. I can get a summary off of. But when you understand when you actually spend the time to read that stuff. Yeah. By the way, I'm not going to agree with. I agree. I'm not going to understand a lot of it, right? And so I have to reach out to people or get information about it or whatever it may be. But I believe in looking at the data itself from the source of the data, and it's not 100% accurate. I can go through that all day long. I've heard all these arguments in regards to just relying on the data. But the second side is it's the best that we have. And so if you come up with an opinion, if you come up with any of that stuff without using that, without going to the source, without spending the time to read, I just don't understand how you can debate the idea of whether this is right or wrong. And by the way, even after I get done with all this stuff, it's still my interpretation of what I'm reading. So it's not going to be 100% accurate. Yeah. That's the reality. And so going back to the point originally, was just that by giving this type of information to these types of clients, an understanding that it's an educated guess still. That's the wonderful thing about economics. Economics is one of the most inexact sciences there are. There's too many variables. So for us to think that we've got it figured out is ridiculous to me.
Yeah.
So
No, I think that's fantastic. It's like, look at the data, understand, get as much source data as you possibly can, try to make the most informed decisions, but there is no crystal ball.
there's no crystal ball.
There is no crystal ball. It's no single indicator is going to tell you what the next thing that's going to happen is going to be. And so you just have to make wise, fundamental decisions over long periods of time.
100%. That's exactly right.
Yeah.
I mean, listen, historical data, I'm sorry for interrupting, but just to this point is that on historical data, I can go back and tell you what median home prices have done since 1900.
Yeah.
Maybe they continue at that pace. It's about 5%. Maybe they continue at that pace. Maybe not. Maybe it's just law of large numbers and it becomes harder and harder and harder to do as we go forward. Maybe. And we have to understand that. Or maybe we continue at this 5% pace every single year.
Yeah.
So
No, I was just going to say, that's impressive that you're reading the bill. I'm not sure if all the lawmakers read it. So you're one of the few.
I was on a train to La Jolla in California the other day and spent 2 hours, and I got through about 50 pages of it. And,
nice.
And then I slept for about 45 minutes afterwards because it put me to sleep.
Put you to sleep.
But it's something that I need for myself.
Yeah.
So that I'm not just listening to what social media and other people are telling me that it entails.
Yeah,
yeah,
absolutely. Yeah.
Good.
Well, man, it's such a great conversation, Richard. I want to now we kind of ask all of our guests the same 5 questions at the end of the episode in a section we call the exit round. I'd love to kick that off and get your answers to these questions. So question number 1, we want to be vogue, we want to be popular. And so it's kind of the popular question on any kind of entrepreneurship podcast. What is your all-time favorite business book?
I'm a social science major in college. So Factfulness is I give a book called Factfulness out to every single client.
Yeah.
And all it is, it's critical thinking. That's what it's about. So it's not about business or, any of that stuff. It's more social science and just thinking, just allowing yourself to understand that critical thinking is necessary.
Yeah, that's awesome. Number 2, what percentage of your current income is fully passive versus active earned?
20%, 25%. If we've been trying to increase that, and we will over time, dollar cost averaging into different investments. But as of now, it's about 25.
That's fantastic.
That's awesome.
That's great. What's one thing that you wish you could do more of, but your commitment to your business holds you back?
Golf.
You mentioned that earlier. I thought maybe golf was going to be it. That's great.
I was about to say you can merge that though, because $1 million deals that happen on the course though.
They happen on the course.
You get a little overlap there, hopefully, right?
I get out 2 or 3 days a week, and so it's whenever I can fit it in, I'm out there. If I can do it 6 or 7 days, that would be ideal.
Awesome.
If you could go back in time, what advice would you give your early self, your 17-year-old self, starting out about building a business?
Listen, for me, it's not being fearful of failure, right? At the beginning, failure is how I learn. I try a lot of different things to build a business over the years. I'm good at some of them. I'm not good at others. I try and get better at the things I'm not good at. But not being fearful of failure is, I think, the best lesson for me, business-wise.
Yeah, that's super fantastic.
Good. All right, last question. What is your strategy for creating time freedom and financial freedom for yourself? And you can feel free to share 1 or 2 strategic tips.
Listen, I have 6 kids, and they're all a little bit older now. So there's so much time in a day that I can incrementally do different things. Even a text to one of my kids, or calling one of my kids to say hello, or calling a friend, or, I have in my office, I have some weight, and I can sit there for 10, 15 minutes. So for me, it's finding everyday incremental growth by doing various things and, read for half an hour. Right? Take a little break from work and just do these little incremental steps. As I said, reach out to family, spend that time so that those moments that you have 10, 15 minutes are not wasted for me, that's the only way to, when you have 6 kids that are everywhere now, you're just trying to say hello and hear their voice or get a response from them. Yeah. And same with friends and, all these, that's that incremental approach is really important.
Come on. That's awesome. Yeah. So increments, one step at a time, moment by moment, reclaim your time in 5 to 15 minute increments. That's good.
Exactly right.
It's really good. All right. Well, Richard, it's been really great getting to know you, kind of hearing some of your insights, and appreciate you on Own the Exit. So, our listeners, how can they get connected with you to learn more from you, learn more about what you do? What's the best way for them to get connected with you?
Yeah, we're on LinkedIn at SRM, Sam Robert Mary Private Wealth, or on our website at srmprivatewealth.com.
Perfect. All right.
Thank you, guys.
Yeah, really good conversation. Definitely, lots of data.
Yeah,
so
it's good information. Love it.
Yeah, really appreciate it.
All right.
Thank you, guys.
Thanks, everyone, for joining us for another episode of Own the Exit. We'll see you next time.
See you next time.